So DSCR loans, one of the key questions that you should always ask when you have a DSCR loan is two main questions. One has to do with the property that they currently live in, whether they live in it, they pay rent, or whether they own it or not. Or the second one, actually the most important, is the subject property. And that's the key to DSCR loans because there's no employment involved at all in these type of loans. So you only care about the property they live in and the subject property. Assuming that they make their payments on time, the subject property, which is the property that they're getting the cash flow for, which is what is the market rent or what is the current rent if it is a refinance. And that's going to determine your DSCR ratio. And DSCR has multiple ratios. One is the best, you get the best pricing. And then if you get market rent that's less than the mortgage payment, which is the determining factor for the ratio, 1-to-1 is market rent. Let's say it's $3,000 is the market rent and your mortgage payment is $3,000. That's a 1-to-1 ratio. If your market rent is less than that, let's say it's $2,500 and your mortgage payment is $3,000, then that's a less than 1 ratio. So those are the two biggest determining factors: the market ratio on the property itself, the subject property, and then their current property, whether they own it or they're living in paying rent for it. That's the determining factors for a DSCR loan.